Across the country, car insurance rates are climbing. Inflation, repair costs, and regional weather patterns are all driving up baseline prices, leaving many drivers feeling financially squeezed by systemic factors completely out of their control. When you receive your renewal notice, it is easy to look at that monthly bill and accept it as a rigid, non-negotiable expense. But insurance companies are simply pricing risk. If you want to lower your cost, you have to trade them something else: your personal time, your localized risk, or your behavioral data. This chart plots our analytical framework. We can evaluate every cost-saving tactic by mapping the personal effort required on the bottom axis against the actual financial impact on the vertical axis. Applying this matrix allows you to target specific savings without blindly slashing your coverage, which is the exact mistake that leaves drivers financially exposed when a crisis actually hits. The first lever available to you is market comparison, taking the time to gather quotes from 3 to 5 different insurance providers. This requires you to actively submit your personal information multiple times. In exchange, you are hunting for algorithmic pricing inefficiencies between competitors who calculate risk differently. This approach consistently yields the highest immediate savings, but you pay for it with your time and the friction of follow-up calls and emails. That places this first lever right here, a high-effort, high-impact strategy. The second lever shifts the focus from time to money, electing to increase your out-of-pocket deductible. This diagram illustrates the mechanical relationship. A higher deductible acts as a heavy counterweight, guaranteeing a drop in your monthly premium. But there's a strict trade-off. By paying less monthly, you agree to absorb thousands in localized risk if an accident occurs. Raising your deductible is only mathematically sound if you already hold that equivalent dollar amount in a highly liquid emergency savings account. Otherwise, you are simply gambling, not saving. Next, we look at the levers of consolidation, bundling your auto and renters or home policies together and stacking available demographic discounts. By bringing multiple distinct assets to a single provider, you trigger algorithmic multi-line discounts. The insurer rewards your loyalty by reducing your overall net spend across the board. The hidden cost of consolidation is ecosystem lock-in. Once your policies are tied together, it becomes highly tedious to extract yourself and switch providers if they hike the rate on just your car. Another systemic lever is conducting a strict coverage audit to strip out unnecessary add-ons from your policy. This means identifying and dropping secondary services you might double paying for elsewhere, like redundant roadside assistance or daily rental reimbursement. This trims baseline costs but trades away convenience. You will have to handle those logistics yourself, out of pocket, during an emergency. Ultimately, these systemic adjustments provide guaranteed baseline savings right now, but they require you to give up long-term flexibility and post-accident convenience. Our final major levers involve your personal history, improving your credit score, and maintaining a spotless driving record. This graph tracks foundational risk tiers. Insurers use your sustained good behavior to place you into descending, cheaper risk categories. This traditional route demands months or years of consistent behavioral change. The return on investment is solid, but the timeline is extremely slow. The modern shortcut to these behavioral discounts is telematics, surrendering your real-time driving data to an insurer's proprietary tracking app. This trades the slow wait for an immediate risk recalculation, but it requires giving up your behavioral autonomy and a significant amount of personal privacy. These behavioral levers secure the deepest structural discounts available, but they demand the highest absolute sacrifice of either your personal time or your digital privacy. You do not need to execute all 7 of these levers to see a difference. Optimizing just 2 or 3 that align with your current personal resources is mathematically sufficient to reduce your costs. This decision tree maps out exactly where you should start, based entirely on your primary resource constraint. If you are budget-strained but have a free afternoon, your optimal path is on the left. Prioritize gathering multiple quotes and executing a coverage audit to strip away unnecessary add-ons. However, if you are in this group, you must strictly avoid raising your deductibles. The monthly savings are not worth the risk of facing a massive, unpayable bill after a collision. If you fall into the time-poor, cash-rich category, your path is on the right. You should prioritize raising your deductibles and bundling your policies. This specific combination maximizes your immediate and long-term discounts via a single phone call, safely leveraging the cash reserves you already have in the bank. Optimizing your insurance pricing is not achieved by frantically chasing every available discount. It is achieved by strategically trading the exact resource you can afford to lose.